OpenAI is now worth more than Ford, GM, and Boeing combined. And you still can't buy a single. What if I told you there's a legal backdoor that lets ordinary investors get a stake in OpenAI right now, before the IPO that analysts are calling the biggest wealth event of the decade, and almost nobody is talking about it? Not hedge funds. Not your financial advisor. Regular people are quietly moving money into positions tied directly to OpenAI's explosive growth. And by the end of this video, you'll know exactly how they're doing it. We're going to cover 3 things. First, the 5 backdoor routes into OpenAI that don't require a single VC connection. Second, the single publicly traded stock that owns a bigger slice of OpenAI than most people realize. Third, the hidden risk that could wipe out every penny of your OpenAI bet, and how to protect yourself. This is not financial advice. But this is the information your broker probably hasn't shown you. Before we get into the backdoor routes, you need to understand exactly how big this opportunity actually is. Let's put OpenAI's valuation in real context. In 2023, OpenAI was worth around $29 billion. By early 2026, that number has exploded past $300 billion. That's a tenfold jump in under 3 years. To put that in perspective, it took Amazon over a decade to reach a similar valuation milestone. OpenAI did it in a fraction of the time. And here's the part that should make your jaw drop. ChatGPT crossed 500 million weekly active users in 2026. That's not a product. That's a platform. Platforms get priced like monopolies. Goldman Sachs analysts have projected that if OpenAI goes public, its IPO could raise more capital than any tech listing in history, potentially surpassing even Saudi Aramco's record-breaking debut. We're talking about a company generating over $5 billion in annual revenue right now, and growing at over 200% year over year. Most investors are sitting on the sideline assuming this is only for Silicon Valley insiders. But the backdoor exists. And it's hiding in plain sight inside instruments you already have access to today. The question is, do you know where to look? So what is Route 1? It starts with a company you've almost certainly already heard. Microsoft. Ticker Microsoft. This is the most direct public market exposure to OpenAI you can buy today. Microsoft has invested over $13 billion into OpenAI across multiple funding rounds. In exchange, Microsoft secured exclusive cloud rights through Azure, a 49% share of OpenAI's capped profit pool, and deep integration rights across every Microsoft product, from Word to Teams to Bing. When OpenAI wins, Microsoft wins. That relationship is baked into Microsoft's revenue model at a structural level. Azure's AI services revenue grew over 50% in the most recent reported quarter. Analysts who cover Microsoft describe OpenAI as essentially a hidden asset on the balance sheet, one the market has only partially priced in. Now, Microsoft is not a pure play on OpenAI. It's a $3 trillion company with dozens of business lines. So the upside is diluted compared to owning OpenAI directly. But here's the thing, it's also dramatically lower risk. If you want OpenAI exposure without the volatility of unproven routes, Microsoft is the anchor position. But Route 2 is where things get genuinely in. Route 2 involves a type of investment most people have never heard of. And it's where there is a legal secondary market for private company shares. Platforms like Forge Global, EquityZen, and Hive allow accredited investors to buy shares from OpenAI employees and early investors who want to cash out early. These are real OpenAI shares. Not synthetic exposure. Not an ETF. Actual equity. On Forge Global, OpenAI shares were trading at implied valuations between $250 billion and $310 billion in early 2026. The minimum buy-in typically starts around $10,000 to $25,000 depending on the platform and the current deal flow. Now, here's the catch. You need to be an accredited investor. In the US, that means a net worth over $1 million excluding your primary residence, or income over $200,000 per year. That locks out a lot of people. But here's what most people miss, some platforms offer SPVs, which stands for Special Purpose Vehicles. These are pooled investment structures that let non-accredited investors participate indirectly. The rules are evolving fast in 2026. So it's worth checking current eligibility on each platform directly. But the cliffhanger is this: there's a Route 3 that requires zero accreditation, zero minimum, and you can fund zero accreditation, zero minimum. It sounds too easy. But this Route 3 is completely real, and it's sitting. In late 2024, ARK Invest and several other fund managers began structuring ETFs with indirect OpenAI exposure baked in. By 2026, at least 4 publicly traded funds hold meaningful positions in OpenAI through pre-IPO structures and venture feeder funds. The ticker ARK Venture Fund, ARKVX, is one example. It holds private positions in AI companies including OpenAI-adjacent infrastructure plays. Beyond ARK, the Fundrise Innovation Fund is another vehicle that has disclosed OpenAI equity exposure in its portfolio filings. Fundrise has a minimum investment of just $10. Yes, $10. That changes the access equation entirely. Now, these funds are not pure-play OpenAI bets. They hold baskets of private tech companies. Your OpenAI exposure is diluted across a larger portfolio. But for investors who don't meet accredited thresholds, this is a real and legal path that exists today. The fee structures on these funds tend to run higher than standard ETFs, often 1.5% to 2.5% annually. That compounding cost matters over time. But the access they provide was completely unavailable to retail investors just 3 years ago. So, what's Route 4? It involves the chip. Route 4 is the infrastructure angle. And the company at the center of it is printing money in a way every single AI model OpenAI trains runs on NVIDIA GPUs. The H100 chip. The B200 chip. The upcoming Rubin architecture chips. OpenAI is one of NVIDIA's largest customers. When OpenAI scales, NVIDIA's revenue scales with it, directly and immediately. NVIDIA reported data center revenue of over $47 billion in fiscal year 2025. In 2026, analysts project that number to exceed $80 billion. The company's gross margins are running above 70%. That is software company profitability inside a hardware business. Now NVIDIA is not a secret. Everyone knows about it. But here's what most people get wrong: they think they've already missed it. NVIDIA's price-to-earnings ratio in 2026 remains lower than it was at many points during 2023 and 2024 because earnings have grown faster than the stock price. The growth has been real, not just hype. If OpenAI doubles its model training capacity over the next 18 months, which its infrastructure roadmap suggests it will, NVIDIA's order book grows with it automatically. This is the picks and shovels play. The gold rush is AI. NVIDIA sells the shovels. But now we need to talk about the risk nobody wants to discuss. Because one specific scenario could unwind but here's where most AI investors go completely blind. There's one risk that could erase gains across. OpenAI restructured from a non-profit to a for-profit public benefit corporation in 2026. That sounds like good news for investors. And mostly it is. But buried inside that restructuring is a clause that almost no financial coverage has highlighted. OpenAI's charter still includes a provision that allows the board to prioritize its safety mission over shareholder returns in extreme circumstances. That means, in theory, the board can make decisions that are structurally bad for investors if they believe AGI safety demands it. This is not hypothetical. Former board members triggered a version of this exact power during the Sam Altman firing incident in 2023. The second risk is regulatory. In 2026, the EU AI Act is fully live. US federal AI legislation is advancing. If OpenAI's core products face usage restrictions or mandatory licensing requirements, revenue growth could stall faster than any valuation model currently projects. The third risk is competitive disruption. Google's Gemini Ultra, Meta's Llama ecosystem, and Chinese models are all closing the capability gap faster than 2024 forecasts predicted. OpenAI's moat is real, but it is not permanent. Diversifying across multiple routes rather than concentrating in one is the simplest hedge against all three risks. And here's the one thing before you go anywhere, there's one final route we haven't covered yet. Route 5 is Route 5 is investing in yourself as an AI operator. Companies that deploy OpenAI's API to build products are compounding value right now, and the barrier to entry has never been lower. The real backdoor isn't just buying shares. It's building on the platform while the window is open. In the next video, we're going to break down exactly which publicly traded companies are generating the most revenue per dollar of OpenAI API spend, and which ones look like traps. That video if this gave you an edge nobody else is talking about, subscribe. We drop one high signal AI finance breakdown every week, and most people find us too late.